Now we're moving on to learning objective 3, and this is a very important part of the chapter. This is just a little bit of work here because overhead is one of those types of things where the question comes up: how do you allocate it? How do you allocate overhead? And so, what manufacturing has come up with is they use something called a predetermined overhead rate. And this particular part of the chapter explains that and how to calculate it. Thankfully, it's usually just a percentage of what is happening in one of the other accounts, usually labor. But you'll see. It sounds interesting. It sounds really predetermined. Yes, this is your fate. This is your fate. But you'll see it's actually just a percentage of some other reality. Ooh, so philosophical. All right. So remember, manufacturing overhead costs relate to the overall production of whatever they're doing. Right? Um, they're going to be paying property taxes. They might be paying rent on the factory, or if they own it, they'll be paying property taxes. There's depreciation. There's other factory upkeep and utilities and so forth and so on. So there's a lot of this manufacturing overhead going on. And so again, they still have to allocate or basically what they call assign it to all of the jobs that they have to do. They have to assign this. So this is what we're going to learn how to do here. Okay. They do it by the predetermined overhead rate. Okay. Doesn't sound like a really good echo. It is what it is. So the predetermined overhead rate basically is usually expressed usually it's as a percentage of some activity base. Labor costs or labor hours are very typical activity bases that overhead is attached to. So they might say if it's a 50% overhead rate, they might say for every dollar we spend on labor, that means we spent 50 cents on overhead. And so that's sort of how they sort of do it. They can also determine it based on, how many hours the machines are running to create the products. And so, for every hour the machine is running, it's costing us $1.50 in overhead. So you multiply the number of hours times $1.50 and boom, you got your overhead. So that's really all they're doing here is they're introducing to you how they do all of this. And it's really not that bad, but again, it's going to be based on some activity that they will define. So you're not going to be lost. This, like a lot of things in accounting, you have to establish this at the beginning of the year when it's happening, before it actually happens. So you do have to somewhat project out. So you establish the predetermined overhead rate at the beginning of the year. Normally speaking, if the company is smaller, they will simply have a company-wide predetermined rate that everybody uses. And it's just one particular rate. And that's a benefit for smaller companies that are in manufacturing particularly. But of course, a lot of manufacturers are extremely large, and they have, various factories, departments all over the country, all over the world. And so they might determine that they need to have a different rate for every department, or they might have to have a different rate for different activities. And so they might determine that as the best way to manage things. But all you need to worry about is the formula. Okay, and as you know about formulas, right? Because you got plankton. Give me the formula, crabs. So you have the annual overhead costs that are estimated, right? Because you have to establish at the beginning of the year. So you're estimating what the costs are going to be this year. And you divide that by the expected operating activity for the year. Again, it's expected. So again, you're sort of predicting this as well. that gives you the predetermined overhead rate, all right, that we're going to be using here. So let's take one more look at this before we actually calculate this thing. So manufacturing overhead costs need also to be assigned to work in process. Okay, just like the raw materials were, just like direct labor was. We have to do the same thing for manufacturing overhead. So this is how we do it. We take whatever base of activity we are using as the at which to predict our overhead, multiply it by our predetermined overhead rate, and that'll give us the total amount of overhead costs that are going to go to work in process inventory. And then, just like all the other ones, those are assigned per job. Okay, so you're going to see this play out in the examples here. Okay, so here we go. Woohoo! Excited. We got an illustration here, the illustration of all illustrations right here. Wallace Company. They use direct labor costs as the activity base. So assuming that the company expects the overhead costs to be $280,000 and the direct labor costs to be $350,000. The overhead rate is the 280 divided by the 350. So the overhead rate is going to be 80% of direct labor. So whatever we have for direct labor costs, we have to assign 80% of that cost to overhead, manufacturing overhead. And that's how they do it. Oh, we have a blank here, and I hate blanks. So let's fill in the blank, shall we? Ooh, 80 cents out of every dollar. Damn, I wish I knew that. That was a trick question. So that's how we're going to be doing. That's how we're going to proceed. So illustration continues here. So Wallace applies the overhead to the work in process, which they have to assign it. Right? They basically assign it on direct labor costs, and we know direct labor costs were $28,000. Okay. Now remember, the predetermined overhead rate, as you just saw earlier, is 80% of direct labor costs. So let's take a look. We know that 80% of the direct labor costs are $22,400. This is going to be the amount of manufacturing overhead that we have to apply to work in process. So then the entry is going to look like this. Work in process inventory will get a debit of $24,000. Sorry, $22,400. My bad. Manufacturing overhead will get the credit because we're moving it out of overhead into the work in process inventory. So again, we're taking that out of the manufacturing overhead account and moving it into the work in process inventory. So now it's in this account here. Fascinating. Come on, Arujo. Is this all you got? Throw more at me. All right, so here we go. This is how manufacturing overhead would look now that we've actually done the entry and you see the $22,400 in the work in process inventory account. We need to allocate that to each of the jobs. Remember, we have job 101, 102, 103. All of them have manufacturing overhead that we have to account for. But now we know that manufacturing overhead is 80% of the labor. And guess what? Your direct labor costs are already given to you here. So the manufacturing overhead is simply 80% of these numbers. This is the total. Fascinating, isn't it? It's just like, are your eyes popping out? I think mine are. I might need some new glasses. Again, so direct manufacturing overhead using this predetermined overhead rate for this company is 80%. So the numbers you see under manufacturing overhead are 80% of the direct labor costs that are next to it. The totals are here. Totals are here. So when you take a look at the totals, 3,200 plus 7,200 plus 12,000, you have $22,400 of manufacturing overhead applied to each of these jobs using the predetermined overhead rate. Damn, this is good. This is good. So at the end of each month, your work in process inventory balance should be equal to all of the costs on those jobs. Okay, so when you look at the job cost sheets, and I'll go back to show you, we're looking at these totals now. So this 39,000, this 23, and this 12 plus, right? When you look at all these, they have a total of $74,400 in job costs. And that should equal the amount of money that we put into our work in process inventory. Fascinating. Please pay attention. Drugs are bad. So do it exercise number 3. That's already done for you in the book. As you know, it's called the do it exercise, but in reality, because they've already done it, it's really a done it exercise. And so we have Stanley Company. They produce specialized safety devices. I hope everyone feels a bit safer now. For this, manufacturing overhead is expected to be $160,000. So they base things on the machine usage. They have 40,000 hours that they expect this machine to be used. And the company assigns overhead based on these hours. So job number 302 has used 2,000 machine hours. So what is the predetermined overhead rate? Dun, 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 dun. Well, basically, again, you're looking at the total costs of 160,000, and they base that on machine hours. So you divide it by the total machine hours. So it's going to be $4 of overhead per machine hour used. So this job used 2,000 machine hours. You would multiply that by the 4 to get the amount of overhead that you are going to allocate to this job. So 2,000 hours times the $4, you would allocate $8,000 of manufacturing overhead costs to this particular job. Fascinating, right? Don't you love it? I do. All right, coming back to our main screen for questions.